Welcome back to Alpha Recap, your quick post-market wrap from stockalpha.ai. Markets closed for the day, and we've got a lot to unpack. From Amazon's big move into satellites to a rate-fueled bounce at the big banks. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. So much happened. Strategic M&A, bank beats, governance headlines. It felt like the market was trying to tell us multiple stories at once.
Totally. Let's start with the headliner. Amazon announced it was acquiring Globalstar, a clear push into low Earth orbit satellite internet. That was the biggest narrative on the tape today.
Yeah, and what really stands out here is that this isn't just a product play. Analysts are saying Amazon wants control of spectrum and ground assets to speed time to scale and to fold connectivity into AWS and devices.
Right, and to put that in plain English, low Earth orbit satellites sit much closer to the planet than traditional satellites, which means lower latency and better internet performance. Buying Globalstar can shortcut some of the build work.
But, and this is a big but, stepping into this market puts Amazon more squarely against SpaceX's Starlink. There's heavy upfront cost, regulatory approvals, and long lead times to actually make money.
Exactly. Some analysts praise the strategic logic. Others warned about capital intensity and integration risk. So there was a mix of optimism and skepticism in the reaction.
Short-term traders reacted to the headline, but longer-term investors will be watching the deal price, any regulatory timetable, and how Amazon ties this back to AWS monetization.
Quick reaction segment.
Wait, really?
Hold on. Say that again?
Yeah, that tracks.
And the number that really caught our eye from the financial side came from Wells Fargo. They reported a net profit of about $6.3 billion, earnings per share of $1.14, and revenue of about $20.2 billion.
That was a big one. The bank's results underscored how a higher rate environment had been helping net interest income. Basically, banks earning more on loans compared with what they pay on deposits. And trading revenues got a bounce as well.
Right, but there was caveating commentary. Some say this could be a structural shift to a higher rate floor, while skeptics warned margins could compress if deposit costs reprice or loan demand softens.
So, what really stands out here is tracking sequential net interest margin, deposit beta, and loan growth. Those metrics will tell us whether this was a cyclical bump or something more durable.
Short take, banks finished the day up on the back of that strength. But the debate about sustainability is alive and well. Not a great day for anyone who likes certainty.
Totally. Another corporate highlight? Johnson & Johnson lifted its guidance for 2026 after pharmaceutical sales grew about 11.2% in the first quarter. That was what moved the needle for them.
And for conglomerates like J&J, a stronger pharma division matters because it typically generates higher margins and steadier cash flow than devices or consumer segments. Analysts will now watch for whether management leans into growth, more R&D or M&A, or returns cash to shareholders.
Speaking of beaten down names, Nike finished the year-to-date down about 32.7%. And that sent it onto contrarian lists like the dogs of the Dow. Those screens favor large, beaten-up names with higher yields.
Yeah, the dogs framework is a rules-based, yield-focused contrarian method. Proponents say mean reversion could happen, but critics point to structural shifts in consumer demand and competitive intensity. So, again, mixed signals.
On the other side of style rotation, Mueller Water products kept outperforming, up about 119% over 5 years, and roughly 22% over 6 months, to around $31. That highlights how mid and small caps have been winners in pockets.
Right, and investors should tease out whether that performance came from real pricing power, backlog strength, or just cyclical tailwinds. Those are different risk profiles.
Another interesting thread today was governance and private capital. The first audit fee survey showed fees were broadly stable for fiscal 2024, yet about 1/3 of finance leaders questioned the value of audits.
That's a red flag for governance-focused investors. It raises a debate. Do audit committees push for more costly but higher quality audits? Or do they accept the status quo to control costs?
And private capital told its own story. Vesper's debut infrastructure fund closed north of €1 billion against an €800 million target. Institutional appetite for private infrastructure remains strong.
Which matters because demand for private infrastructure can put upward pressure on valuations and potentially influence relative performance versus public markets over time.
Quick reactions. Yeah, absolutely.
We also saw regulatory filings worth watching. Semi-LEDs filed an 8K with results and exhibits. Standard disclosure. But Nature's Miracle filed an 8K saying management no longer relies on previously issued financial statements. That non-reliance filing often presages a restatement or material revision.
Investors should pay attention to auditor commentary and any independent committee disclosures. Those filings can change valuation and liquidity quickly.
Let's pull this together by investor type. Short-term traders and event traders saw obvious volatility around Amazon's deal and the bank beat. So there were momentum opportunities, but with higher event risk.
Income and yield investors had mixed signals. Nike showed up in contrarian yield screens, while J&J looked more like a dividend sustainability story, backed by stronger pharma cash flow. Governance questions add an extra due diligence step.
Long-term value investors had examples on both ends. Mueller Water as a niche winner, and Amazon's deal as a strategic pivot that needs careful evaluation of capital allocation.
Institutional allocators should be rethinking private versus public exposure, given that oversubscription in private infrastructure. Liquidity management matters if you tilt more toward illiquid investments.
And governance-focused investors need to monitor non-reliance filings and audit committee disclosures closely. Those are real event risks.
Okay, 3 quick watch list items to leave listeners with. Monitor the specifics on the Amazon Globalstar deal: price, regulatory timetable, integration guidance. Watch sequential net interest margin, deposit beta, and loan growth for banks. And read the flagged 8Ks for disclosures that could change the story quickly.
Final takeaways. 1. Amazon's move reshaped the competitive map for LEO connectivity, but brought capital allocation questions. 2. Higher rates helped bank results today, but durability remains contested. 3. Governance and private capital flows are shaping allocation decisions and could influence public market performance.
And remember, this analysis is informational only. We're not recommending anyone buy, sell, or hold any security, and we're not giving personalized advice. Analysts note these points are based on public filings and market commentary.
That's it for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. And don't forget to send us your questions at stockalpha.ai.
Thanks for listening. Talk to you next time.